Hey everyone, Mike with Financeable here. I've got another interview question review for you today. If you find these videos helpful, please do hit the subscribe button below. We've got a lot more of these coming. Let's hop in. All right, today's question is, describe a cash flow statement in plain English. So there are some interview questions you'll get in investment banking, private equity, and hedge fund interviews where they just want to see if you understand the substance of the accounting and finance that you're talking about, and this is a great example. A cash flow statement can be explained in a very technical way, but in order to really explain the substance of it, you have to understand what the cash flow statement is attempting to do. So what we're going to do is take a look at this cash flow statement and just make sure we understand all the components. And what I'll do is I'll walk through the components in a little bit more detail, a little bit more technically, and at the end we'll zoom back out and then take a look at the big picture answer that you typically want to provide in an interview. So to begin with, there are three sections of the cash flow statement. There's cash flows from operations, cash flows from investing, and then cash flows from financing. Let's get rid of those. And what we're trying to capture here is, what do these three sections mean in plain English? Let's start with the first section, and as I said, I'm going to start with a technical explanation and then we'll zoom out to a bigger picture plain English explanation. So to start with, we have net income. Net income is the accounting profit of a business, and it incorporates all operating costs, all capital structure costs, so your debt and your equity, your taxes, and so on. And the important thing to understand is that net income is based on accounting rules, so it's not necessarily reflective of cash. It has accruals, it has all sorts of disconnects between cash and accrual accounting that make it so that it's not an actual cash number. What we need to do is iron out the disconnects between cash and accrual accounting, and that's really what this first section does. So we start with our net income, which we know is not necessarily reflective of cash. And then the first thing we do is we add back our non-cash items, which is primarily going to be depreciation and amortization, stock-based compensation expense, and to some degree for LBO models, PIK interest, which is a non-cash interest charge. In short, what these charges represent is accounting expenses where there's a deduction that lowers net income, but it's non-cash in nature. And so we want to add that back because it's not actually a real cash outflow. Then we go a little further down and we look at our changes in working capital. And with changes in working capital, what we're seeing here is again a different form of disconnects between cash and accrual accounting. So an example would be accounts receivable. If let's say we have $100 of revenue that we had recorded, but the person who bought the good said, I'll pay you in, let's say, 30 days, but the sale is substantially complete, in that case, we would create accounts receivable of $100, and that full $100 would be in our income statement, which would flow down to net income. Well, we didn't actually collect that $100, and that has to be ironed out. And there are a series of other examples along the same lines. Accounts payable would be a similar concept where we receive inventory, but we haven't actually paid the cash for that inventory. And so the short story with changes in working capital here is that we're further ironing out the disconnects between cash and accrual accounting for all of our working capital items. Once we do that, we then get cash flows from operations. One way to conceptualize this in a more accounting manner is cash net income. In a sense, cash flows from operations is just the cash version of net income. But if you asked a business owner what their cash net income is, they'd probably look at you in a strange way because that doesn't necessarily mean anything to them. Rather, a business owner would probably think about this as the cash my business made in a given period. So that's the first part of this answer is cash flows from operations works out the accounting impacts to get to the cash the business actually generated in a given period. Now, let's look at the next section. Down below, we have cash flows from investing. Cash flows from investing are really just reinvestments in the business in some form or another, as well as some investment purchases. So to begin with, the biggest item you'll want to know for this section of the cash flow statement is capital expenditures. Capital expenditures are our purchases of physical property, plant, and equipment, and these are the investments we need to make in things like factories and trucks and physical equipment to make our business grow. Now, if I'm answering this in an interview, you could probably stop there, and I'd probably recommend you stop there because you probably want to keep this simple. But I would like you to know that there are a few other little odds and ends that we have in this section that we probably want to know are there just in case someone probes deeper on the question. So the first thing you'll see beyond purchases of property, plant, and equipment are cash outflows to acquire businesses. So if we acquire a business, the payment for that acquisition will show up in this section. The other thing you'll see is our investment purchases for longer term investments. So if we buy investments for the business to put on our balance sheet, let's say we buy treasuries or something along those lines, that's going to hit this line as well. And then when we sell it, it'll actually be a cash inflow in this section of the cash flow statement. So our investment purchases and sales are going to show up in cash flows from investing as well. But if you're answering this in an interview, what I would recommend is you simply say that this section largely reflects reinvestments in the business in the form of capital expenditures. And if someone wants to probe deeper, sure, you can answer that question, but I just leave it there as a starting point. Now stepping back to the bigger picture, the second section of the cash flow statement really just reflects reinvestments in the business in the form of purchases of physical property, plant, and equipment. Now let's move to the third section, which is cash flows from financing. Broadly speaking, in cash flows from financing, we're going to capture cash in and out from lenders and investors. So the first item you'll typically see in this section of a cash flow statement is increases or decreases in debt, which I've just summarized as changes in debt. So if I raise debt, if I issue new bonds or I take on new loans, I'm going to get cash in the door, and at some point I have to pay down those loans, and that'll be a cash outflow in this section of the cash flow statement. Now, that's not the only source of financing that I have as a business owner, though. I also have equity, and we want to reflect equity cash flows here as well. So if I issue new stock or equity, that would be reflected here as long as I'm getting cash in the door. With equity, though, I don't pay down my equity. Rather, I repay my investors or my equity holders. And so the other two components that you're going to see in this section of the cash flow statement are the two items where we repay our investors. The first one is dividends, which are direct payments to our investors. And the second one is stock repurchases or share repurchases, where we buy back the shares of the company to lower the share count to increase the earnings available to each owner or shareholder. That wraps up the third section of the cash flow statement, which is cash flows from financing. And again, stepping back to the big picture, really what this section reflects is cash flows in and out from lenders and investors. And then we go to the bottom of the cash flow statement, which is cash flows from operations, cash flows from investing, and cash flows from financing equals the change in cash for a given period. So to step back now to the big picture of the entire question, the way I would answer this in an interview is cash flows from operations reflects the cash generated by the business in a given period, and what we're really doing there is just ironing out the differences between cash and accrual accounting. Cash flows from investing reflects reinvestments in the business, primarily in the form of property, plant, and equipment. And cash flows from financing reflects cash in and out from our lenders and our investors. And when we sum all three of those up, we get the change in cash in the period for the business. So hopefully that helps and provides a little bit more clarity around how you'd answer this question. Describe the cash flow statement in plain English. Definitely hit the subscribe button. We have a lot more videos coming and hope to see you soon.